Hi, it's John Kelly. In this module, we are going to discuss Rule 204 and just the parts of Rule 204 that have to do with threats and safeguards. And as always, we want to be efficient and effective, follow professional standards, and document what we have done properly. 204.3 talks about threats and safeguards. And there are prohibitions and there are threats and safeguards. And prohibitions are threats that have no safeguards, so you just can't do them. Threats come with possible safeguards, so if the safeguard, in your view, is sufficient to deal with the threat, it's a threat that's been adequately dealt with. Now, one of the things I see in practice is people who treat prohibitions as threats. For instance, you are prohibited from doing the audit and doing valuations that affected the audit. And people say, well, how do I get around that? What can I do to avoid that? Well, the answer is you can't. It's a prohibition. You can't do it. The other thing I see is people treating threats as prohibitions. So for instance, long service with a client is a threat. In a public company, it's a prohibition. There's a limited period of time that you can serve as the audit partner for a public company. But if you're in a small firm, long service is possibly a threat, but perhaps there are safeguards that can deal with threats, so you don't need to do anything, like you don't need to have a rule that, oh well, we're going to rotate all our partners after 3 years on any client. That's unnecessary. You treated a threat as a prohibition, and that's not necessary. So pages 40 to 52 of the code identify threats, tell you to identify them, tell you to consider their significance. Are they significant or not? And then to apply safeguards. And some are going to be automatic. For instance, one of the safeguards is your firm is subject to practice review. And in Canada, every firm is subject to practice review. So you may conclude that that safeguard, which is automatic, deals with the threat. And if the safeguards aren't enough, you have to either eliminate the threat or resign. Now, many safeguards already exist. I've said that, and we're going to see there's a list, and informing the audit committee or making sure the client knows sometimes deals with the threat. In a small firm, it's probably the easiest. The threats are not that significant. In a big firm is probably the next easiest. That's counterintuitive perhaps, but it's the next easiest because someone else is doing it for you. And if you're working for a big firm, you don't have to worry about it too much. A middle-sized firm, and perhaps if you're part of a network, that's going to be the hardest because you're going to have to do it yourself and understand what the network does and read the rules very carefully. So threats, 204.4, the firm leadership is to stress that these are threats and they're to be dealt with. And perhaps there should be an annual message around the time of independence confirmation to all staff, advising them of that and advising them to follow the rules. Self-interest threats, most are prohibitions. Financial interest that creates a self-interest, those are pretty much all prohibitions. One of the concerns is worrying about losing a client and doing anything you can to save the client or to cause them not to leave. That's a threat, and you shouldn't do that. And there are probably few safeguards you can impose other than internal safeguards. Internal to you, I mean. Other threats, self-review, pretty much are all prohibitions. For instance, doing a valuation and doing the audit if the valuation affects the financial statements. Advocacy, you can't. And we got to be careful we don't confuse this. Explaining something to a client, being an expert witness in court and explaining a circumstance to the court isn't advocacy. And indeed, if you were an expert witness and you were taking your client's side really, really hard in court, you would probably be kicked out by the judge. And so don't do that. Intimidation threats, the client's intimidating you. You have to be careful about that. The familiarity threat, long association. This is stated as a threat. Now, when I explain this to academics, they all roll their eyes because there's a fair amount of research that shows that long association with a client is beneficial. You know what they're doing. They're not able to get away with stuff because you've been around for a long time and they can't pull the wool over your eyes. The research shows, for instance, that most problems in audits that auditors get sued for occur in the first 2 or 3 years of involvement with a client. So changing the partner every 7 years is perhaps a really bad idea. Notwithstanding, those are the rules. Public company, audit partner cannot serve for more than 7 years. So notwithstanding what the research says, those are the rules. Non-public clients, familiarity, long association, there are safeguards. And the safeguards are discussed with the audit committee or the board or the shareholder. The fact that the firm is subject to practice inspection, and the fact that the firm does its own internal quality control review. And I think perhaps you might have that on a checklist. And I think perhaps you might conclude that the first 3, that the client is well aware that you've been involved for a long time, and that yes, we're subject to practice inspection, and yes, we do an internal quality control review, will be sufficient to deal with the familiarity threat. Those are adequate safeguards. If you conclude for some reason that those safeguards are not appropriate, the firm might replace personnel or have a second partner review by another partner perhaps. But those are, I think, things that would happen only in very, very unusual situations. So I think as we annually with a client consider our independence, we should have those questions on a checklist and see whether or not we conclude that we're okay. The other thing about this is, do we want independence or do we want ignorance? Because if someone is involved as a partner who has very limited involvement with a client, they're going to be ignorant and they are not going to be able to do their job as partner well. Someone who has long experience with a client, knows exactly where everything is hidden and what's going on, will probably be able to do a better job. Non-assurance services. There are limitations on doing non-assurance services for an assurance client, but not included are tax compliance work, preparing the tax return. That's not included. We can do that. Anything that the audit committee asks us for. So we're not allowed to be the internal auditor if we're also the auditor, but if the audit committee asks us to undertake a certain internal audit function, then we can do that. And pretty much anything that the audit committee says, hey, we'd like our external auditor to do this, is okay. Litigation support is not included, so you can provide litigation support services. You cannot provide an evaluation of the outcome. That's for the lawyer to do, but I've seen firms that provide litigation support services where they archive all the documents in a large lawsuit and they have them available, and if the lawyer or the court wants to see a certain document, they've got the database and can provide the document quickly. So that's the kind of litigation support that you can provide. Other non-assurance services that you can provide: expert witness confined to the facts, and I've said that before. If you are an expert witness and you stray from just providing the facts and interpreting the facts independently and without bias either towards your client or not towards your client, the judge will get mad at you and throw you out of court and not listen to your expert testimony. So be very, very careful to be very independent and unbiased and state the strengths and weaknesses of the position. If you don't, because as an expert witness, you're the servant of the court. You're working for the judge. You're providing assistance and information to the judge on a complicated matter that the judge is beyond his legal expertise. So you're providing accounting expertise. So be very careful with that. You can do it, but be careful with it. The internal control memo, of course, you're making recommendations that the client should do something different. That's okay because the client has to approve the changes. And anytime you are providing a factual explanation of a position, this paragraph of IFRS says that, and accordingly, this is what we have done. That is not advocacy, and you can do that. It's also very important that we don't make decisions. The client makes the decision. We can make recommendations, we can make observations, but we do not make decisions for the client. So the client should acknowledge their responsibility for decisions, and perhaps that's a paragraph you should have in your rep letter to document the client saying, yes, we know we've made the decision, we've thought about your recommendations, but we've made the decision, you haven't. Discussing the work with the audit committee or the sole shareholder or the board of directors if there is no audit committee. Disclosing the work you've done to the audit committee. It's a very good idea anyway, but letting the audit committee and the client and the board and the sole shareholder know what you're doing. Now, once you get to public companies, the rules become more specific and they become prohibitions, not just threats. So you have to be careful if you're dealing with a public company. There are more specific rules. The one word we should never use is the word prepare. You should eliminate that word from any part of your audit documentation. We don't prepare, we only propose. So you are prevented from preparing adjusting journal entries, but you are encouraged to propose adjusting journal entries. Of course, your job as an auditor is if you find something that you think is misstated, you would say to the client, hey, I think this is misstated, and hey, here's the journal entry that you should make to fix it. Be careful that you describe any journal entries that you provide to the client as proposed entries, and they are to approve them and they are to make them. And we would never prepare the financial statements. We would only assist in the preparation. And the rules are clear. We can help with the preparation of the financial statements. Of course we can. And specifically, we can help with the preparation of the notes. In a small client, probably the client really has no idea at all what to do in the notes other than they say, well, last year's notes look good. Is there anything we have to add? We can help with that by helping them, assisting in the preparation, but we're not preparing the notes. So we should never say, we prepared these notes, here, put them in your financial statements. We should say, we propose that you should add these notes to your financial statements. Now, end result's the same, but never say prepare. And the safeguards in this are the client is to prepare all source documents, and the client is to prepare all assumptions, and the client is eventually to approve the financial statements. So both of those bullet points there should be something you might have in a checklist. And certainly at the very end of the rep letter, you should say something like, we have approved all the journal entries you proposed, and we have approved the financial statements, maybe that you helped us prepare, but not that we have approved the financial statements that you prepared. That's bad language. So don't use the word prepare ever. So in the rep letter here, we would say, we have approved the journal entries you have proposed. Very important, the date. The date the board approves the financial statement for both an audit and a review has to be, well, it's most convenient if it's the same date of the audit report. So useful to document that in the rep letter and say, the financial statements have been approved by the board on such and such a date. And once you've got that in the rep letter, you can date the audit report. Now, as a practical matter, you normally prepare the audit report and the attached financial statements, and you prepare and provide to the client the rep letter. So normally what you would do is say, well, when is the board meeting to approve the financial statements? Next Tuesday. Okie dokie. So the financial statements would be dated next Tuesday and the rep letter would be dated next Tuesday. And when we get the rep letter back and signed and have it in our file, then we can sign and issue the audit report or the review engagement report. The client would also say that the client has prepared all the source documents and that the client has prepared all the assumptions. So very useful to get that in the rep letter, and then we have dealt with the threats, and here is the documentation in the rep letter that we've properly dealt with the threat. Fees generated 15%. I actually thought, I put in a checklist quite some time ago that the fees generated by this client are no more than 15%, and I thought that was kind of funny. And my partners thought that was kind of funny too, because in our firm, just no way that any single client would be at 15%. That's a very, very large percentage in the context of our small firm. That became the rule, 15% of fees. And I suppose perhaps in some firms, maybe that could happen. I don't know. The safeguards are discuss it with the audit committee to let the audit committee know that it's a very big client, or that they are a very big client of yours, that you are subject to practice inspection, and that you have annual quality control. So perhaps even if the fees were 15% or more, you could decide that those safeguards were satisfactory. At very least, though, you should have a checklist step to see if the fees are 15% of the firm's revenue, which I think in many, many firms is highly unlikely. But it's a threat. Those are the safeguards. You should check for every client that the safeguards have dealt with the possible threat. Complex transactions. Of course, we can help. That's our job as auditor or reviewer, is to help the client. But we never prepare. We always propose. If it is very complex, walk down the hall and talk to somebody else and kick it around and say, here's this complex transaction. What do you think we should do? And I will say that there are many times that I thought I had the right answer to something, went to talk to someone else and found that my answer was pretty good, but that the correct answer was somewhat better, and that chatting with someone and kicking it around and looking at professional standards together improved the solution. So it's always a good idea to talk to somebody else. And again, it's important that the client approves it in the end. We can help, we can propose, but in the end, the client takes responsibility. That's why I had suggested those representation letter paragraphs. Overdue fees are a threat. And I guess simply, why are we doing work if we're not getting paid? If last year's fee hasn't been paid, why are we doing any work this year? Like, what's the point of that? So it's an independence threat. We need to think about whether the safeguards are there, but perhaps most of the time you're just going to say to the client, look, it's been a year. If you haven't paid me, I'm not doing the work this year. But it's a threat. Again, checklist, document, consider the safeguards, and probably decide that you're not going to proceed until you get last year's fees paid. So in overview, read, understand, and follow the rules. I said that before. Useful to have checklist steps to help analyze and document the decisions you have made and to remind you of things like 15% of fees. If I didn't have that in a checklist, I'd forget to think about it because it's just not going to ever happen. So I wouldn't document that I thought about it and know I was okay. Those standard representation letter paragraphs I think are very important. Make sure your representation letters include them. And don't ever use the word prepare, ever. We never prepare, we always propose. So, thanks for listening.